Okay, how are we doing time?
Small.
Oh, we're right at the top of the hour. We are scheduled for a little bit longer. Normally we're scheduled for an hour, but we're scheduled for an hour and a half to leave lots of room for Q&A. So I want to get started right on time. This is being recorded, so if you've registered and you have to, if you can't attend for the entire thing, we'll send it out after the fact. And if people have registered and can't attend, we had a couple hundred register, so we'll have a lot of people that will get the recording. Thank you, John, for agreeing to do this. I see is that your bourbon behind you?
Yes, that people ask, is that a wallpaper? And I'm like, oh, good Lord, no, that's real alcoholism right there.
I brought mine over just in case I didn't want you to drink alone, just in case. I didn't have any bourbon at this house, so I got some rum and some scotch. So I won't let you drink alone if you start. So thank you for. So thank you for doing this for us. For those of you who don't know, this is John Hyre. He's a tax attorney. You're out of Puerto Rico. What, do you still come to Ohio too, or you're there permanently?
Yeah, it's less. The kids all graduated Ohio State and went elsewhere, but my parents, I grew up in Youngstown, so my parents are still there. So I'm usually in Youngstown or visiting my wife's family. She has some family in Columbus.
Okay, great. Yeah, I'm from Youngstown, and my brother lives in Columbus, so similar. And you have an event coming up in Puerto Rico, don't you? You're welcome to share that with the folks on if you want.
Okay.
Is that in
We
March?
put that on the left slide, the propaganda. So we'll give them the good stuff first and make them want to listen to me, or realize they hate me and never want to see me again. But either way, then we'll do the propaganda after.
Okay, perfect. Well, without any further ado, also, we don't have the chat going on, but if you have a question or that you want to pose to John, type it in the Q&A, and then I'll read those to him and we'll answer those live after his presentation. So send us any questions that you have in the Q&A. And John, I'll let you take it away.
Cool beans. All right, so my name is John Hyre. I am an attorney, accountant, investor. That's my rough order of competence. As you gathered, I'm from Ohio originally, and about 5 years ago moved to Puerto Rico. I get a massive tax break. My attorney and information product income is basically taxed at 6% grand total. I don't pay federal income tax. That makes me very happy. So I have a tax lawyer who sort of lives by his principles, such as they are. So here's the contact data in the event you want to get a hold of me, or just, send hate mail and all that sort of thing. If you want to cancel me, there's the website to docs, you got it all. So speaking of, let's go to the caveats. This is not legal advice. Legal advice occurs when you give me little green pieces of paper, namely 1,000 of them per hour. I look at your personal facts and circumstances, and I give you personalized actual legal advice for which I could be held liable if I were negligent. This is not that. This is education. So lots of Q&A, lots of good knowledge, but not legal advice, tax advice, etc. Indeed, if you try this alone without somebody competent advising you, you're probably going to win a financial Darwin Award. So don't do that. Also a warning, just nowadays you have to do it. Guys, I'm not woke. I'm not going to change my language or any of that to cater to those of you who are. So I've discovered, because you always discover things the hard way, some people need what they call a trigger warning, and this is yours. So if you want to talk IRAs and that sort of thing, and you don't mind a little bit of naughtiness, which I'll certainly provide, I'm your guy. If you are sensitive or triggered, yeah, very seriously here, not kidding, not me, not the guy.
Very good.
All right, Checkbook LLCs. I'm going to talk about what you need to hear. Some of it you're going to like, some of it you're not going to like, but it's all going to be explained in the fashion of why. I don't just tell you things so that when some fool from Nevada or Utah, because they seem to be in the legal and accounting and financial asset protection industries, a lot of them from those places, when they tell you the opposite, it's not enough that I tell you one thing, they tell you another. What do? Flip coin, break tie? No. You know why. We're going to walk through why so that you can understand. And maybe you disagree with me, and that's okay, but you have the reasoning that you can then counter. So checkbook LLCs have gotten complex, and I don't think this has gotten a lot of press. Why? Because they're so convenient and everybody loves them, and nobody wants to hear they've gotten complex. Lamentably, they have. So don't get me wrong, I don't like it, but it is what it is. The McNulty case, this came out about 2 years ago. There was an LLC, 100% owned by the IRA, The manager was, of course, the owner of the IRA. This is a classic checkbook LLC structure. The LLC itself and the operating agreement were very low quality. By the way, I have not set up, with one exception, a checkbook LLC in 2 years. I think I've done one.
Hmm.
And the reason is when people call me, they just want to bid. Tell me how much it is. That's all I want to know. And I'm like, I'm not the lowest. Go away. And that, of course, endears me to many, or that could be why I haven't set up any. But I don't want the liability. I ask questions. And we'll talk about, if we have time, some of the best practices with checkbook LLCs. They do have a role, but they need to be done a certain way. But that requires actual Q&A and discussion. Oh, John's just trying to bill more hours. No, if actually you've been around me, you know I'm going in the opposite direction. I sell way more content and time, and I'm really not trying to pad the clock, very much the opposite. But there are, I think, questions that need to be asked. I think a lot of people are going to be on the hook for negligence or malpractice when push comes to shove. I look at who sets up the checkbook LLCs, a lot of non-lawyers, a lot of lawyers, a lot of tax lawyers who don't know anything about IRAs, not a lot of people who've actually been to tax court, like say, oh, I don't know, me, on self-directed IRA issues. I also tend to do my homework. But she bought anyway services from Checkbook IRA LLC. That's part of the public record. I don't know who they are. I was not impressed with their documents. That's how much I know. She did something that I've been saying for years you shouldn't do. And again, I don't say it because I'm mean. I mean, I am mean, but that's not why I said it. I said it because I thought it was a bad idea. She, through an IRA, owned gold personally. Well, I mean, she did it through her Checkbook LLC, right? The money went from the IRA to the Checkbook LLC, pretty normal. Checkbook LLC bought gold. She then took physical possession and put the gold in the basement. Now, for a variety of reasons, mostly code section 408M3, me and several others have been saying, yeah, I don't really think you ought to do that, but they did it, and it went very badly. So she lost the case, and we'll get through some of the important language. Let me tell you really 3 things for me that came from the case. Here's the obvious one. Don't physically touch IRA assets. That's why God gave you custodians, right? And they're going to say this in the case. The court makes really, really clear. The statute sets up custodians for IRAs, not so much for 401ks, but for IRAs, HSAs, Coverdales, other accounts. There is a custodian. And the tax court does not like you going around them. They think they exist for a reason. And so that was the obvious one. Now, how are the checkbook people spinning this to the extent that they even bother to look at it? Well, this only applies to gold. So fine. You can't have gold in the basement. Well, it said a lot more than that. The court did a lot of talking, and it warned us where it was going in the future, and kind of gave the IRS a little volleyball set to the net so they can do a spike. Let's talk about that, because the other 2 things they said, these are very important. One I sort of mentioned, the custodian is really important with an IRA. We don't like you going around them at all. So that wasn't a legal ruling, it was a warning. Second, they said, if you have, and this is a really important term, McNulty had physical possession, but the court, they didn't have to say this, but they went ahead and said it. And I think there's a reason. They said, by the way, even if you don't have physical possession of an asset, if you personally or any disqualified person has constructive possession, not physical, actual possession where you can touch it, like, hey, oh, look. That's physical. Constructive is if you have control over the thing. We're going to talk about that. It's really important. So the court actually gave us some juicy quotes. I mean, you could just quote them directly. It was so clear. Independent oversight by a third-party fiduciary, that would be the custodian, to track and monitor investment activities is one of the key aspects of the statutory scheme. When coins or bullion are in the physical possession, we'll talk about constructive possession in a minute, of the IRA owner, in whatever capacity the owner may be acting. In other words, Mrs. McNulty said, wait, I'm not Mrs. McNulty, the human being, the carbon-based life form. I'm Mrs. McNulty, manager of the LLC and noble. And the court said it's a single member LLC. Under tax law, we disregard single member LLCs. It's in fact called a disregarded entity. So the court said, we're going to give you what you wished for. You set up a disregarded entity. And you know what we're going to do? We're going to disregard it. So it said Mrs. McNulty we don't care about her capacity because we're disregarding the entity she is supposedly a manager of. In other words, it's her. So going on after the parenthetical, there is no independent oversight that could, and that's an important word, could prevent the owner from invading her retirement funds. They don't want that. Understand that. They don't want owners to have the ability to invade their retirement funds, whether or not they actually do so. That's why custodians exist. This lack of oversight with the Checkbook LLC structure in this case is clearly inconsistent with the statutory scheme. Those are strong words. I'm taking it straight from the court. And hey, I thought that was on silent. I don't know why that's still making noise. Sorry about the dings. Hopefully there won't be too many. This lack of oversight is clearly inconsistent with the statutory scheme. Personal control over the IRA assets by the IRA owner is against the very nature of an IRA. Now, that would make me nervous. Evidently, everyone else not so much, because people are still doing it. Again, they're looking at the case and saying, well, it only applies to gold in the basement. But I think this is saying something else. I think this is telling, by the way, a caveat. How do I look at the law? I assume you're getting audited, and I assume the IRS employee auditing you knows what they're doing. I want to keep my license. So I'm going to give the best legal argument for us and the best legal argument for the IRS, but I'm assuming we're actually going to follow the law. For those of you who aren't going to get caught, or the agent who catches you is stupid, well, you can just log off now. You don't really need me. But just understand where I'm coming from, because you say some of this is paranoid. Well, that's my job, because prohibited transactions, among other things, destroy your account. And because we have such harsh penalties for being wrong, I need to be paranoid. Plus, if they are out to get you, and they are, just not always really competently, then maybe I'm not paranoid. So next slide. Mrs. McNulty had complete unfettered control. Those are really, really important words. You're going to hear them again. Mrs. McNulty had complete unfettered control over the American Eagle gold coins and was free to use them in any way she chose. This is true irrespective of the Checkbook LLC's purported ownership of the American Eagle coins and her status as the LLC's manager. Once she received the American Eagle coins, there was no limitation or restrictions. They were grammatically correct. There were no limitations or restrictions on her use of the coins, even though she asserts on brief she did not use them. Understand what they just said. There was no limit on her use. We don't care how she used them. There was no limit. That they did not like. While an IRA owner may act as a conduit or agent, and we'll talk about that in a minute, of the custodian, she may do so only as long as she is not in, here's this important word, constructive or actual receipt of IRA assets. I would note that the rules for 401ks are different. Who's the custodian with a 401k? The trustee. Who's the trustee? Typically you. Now, it doesn't have to be. There can be someone else as the trustee. This is not really an issue with 401ks, because 401ks do not mandatorily have a custodian. The statutory structure is just different. An owner of a self-directed IRA may not take actual and unfettered possession of assets. That's what she did. It's a basic axiom of tax law that taxpayers have income when they exercise complete dominion over it. Here's the important part in blue. Constructive receipt, which we do not want. It's the same as physical receipt. It's bad. It means the asset is distributed, whether you have physical receipt or constructive receipt. So we're going to talk about what that means. Constructive receipt occurs where funds are subject to the taxpayer's unfettered command, and she is free to enjoy them as she sees fit. They even gave a case citation for that. Mrs. McNulty's possession of the American Eagle coins is a taxable distribution. Accordingly, the value of the coins is includable in her gross income. Taxpayer, that's petitioner, taxpayer's arguments to the contrary would make permissible a situation that is ripe for abuse, having complete control over those assets, and that would undermine the fiduciary requirements. Jill knows a lot about that because she's the fiduciary of Section 408. Mrs. McNulty took possession of the coins and had complete control. Accordingly, she has taxable distributions from her IRA. So let me ask you a question. They defined constructive receipt. You have complete and unfettered control over an asset. Given how most checkbook LLCs are set up, Does the Checkbook LLC manager have complete and unfettered control over the bank account? Could they write themselves a check? Not did they. The court doesn't care if you do. They ask very clearly, could you? Do you have the complete and unfettered ability? Get in the bank account, send yourself a wire or a transfer or cut yourself a check. The way most checkbook LLCs are set up, I think the managers do have that kind of control over the bank account. And I think there's a risk that any dime that touches the bank account could be deemed distributed. And I don't think we can just ignore this. The court wrote all that extra language. They could have made this a much shorter case and said, yeah, she touched the gold. It was physical, we're done. They chose to go out of their way to talk about the importance of custodians and not having constructive receipt or unfettered control. What's one solution? And it's a case where the solution may be worse than the problem we're solving, often the case whenever we're dealing with government. One solution is you have no ability. We do your LLC, you have a checkbook LLC. We change it so that you have no ability to move money from the bank account. We have a separate non-disqualified person, of course, acting as a manager. They're the banking manager. You're the operations manager. They're the banking manager. So our operating agreement's getting a little more involved because we have to define what they're each allowed to do. But you are not allowed to touch the bank account. You're allowed to look at it so you can see if she ran off to Brazil with it, your banking manager. The banking manager, typically the way I draft these is, the banking manager can only write checks when you order it to do so, but there are hard prohibitions in the operating agreement against the banking manager writing checks to you directly or indirectly. And that's where you can say to the IRS, I do not have complete and unfettered control. I can tell the banking manager to do this, and she won't do it. It's prohibited in the agreement. Now, some of you might say, well, I can do an easier one. How about we just change my existing agreement to where I have complete control over the bank account? That remains, and we just write an extra sentence. John will not distribute money to himself. Does that change the fact of your control? No, you just got a piece of paper that says you're not going to do that. The difference is with a separate person, that's binding on them. They're a fiduciary. Under Ohio law and other states as well, that banking manager, if she does something that is prohibited in the operating agreement, it is a clear prohibition, she's liable. That's a legal fiduciary duty. It is a powerful duty. I think the IRS would look at that and say, that's probably real. If you just write language in saying, John owns 100% of the LLC, and John has access to the bank account, P.S., John won't write himself any checks. I think that is meaningless. I think the court will ignore that exactly the way they ignored the fact that Mrs. McNulty was the manager, not Mrs. McNulty, but Mrs. McNulty, the manager of the LLC. So it's something to think about. I don't like it. What's the trade-off? What's the problem here? Well, you got another human being involved. They could be late. They could decide to help themselves. Now, what's a big guard against that? Keep most of the money with the custodian. Keep enough in the bank account that you have an operating account. Let's say you have a whole bunch, it goes to the custodian, because the nice thing about these single member LLCs is you can move money back and forth like that, especially with modern tech. So what's one of the solutions to that? You keep most of the money with the custodian. You only fund the bank account with large amounts when you're doing something like, say, buying a property. And that's kind of your safeguard to make sure the banking manager doesn't go nuts. But is it a pain in the rear to have a separate banking manager? Yeah. Does it create risk? Yep. And now you have to decide as business people, which risk is worse. I wanted to point this out, and I gave you the language from the case, because a lot of people, there's going to be a lot of gnashing of teeth and rending of hair at what I had to say here. And that's why I gave you the language. Read the language and tell me I'm wrong. Show me where I'm mistaken. I'm always open to being mistaken. Good Lord knows my wife has trained me in that. I would ask yourself, do you really need a checkbook LLC? I'm not like most lawyers. Lawyers seem to love complexity for the sake of complexity. I like simplicity, unless complexity pays for itself. When do you really need a checkbook LLC? I can think of two situations. Asset protection. So you have rentals. You really do want some sort of LLC in place to provide some level of asset protection. IRAs probably aren't going to provide it, at least not outward. In other words, someone trips and falls on a rental property. Will the IRA as a trust protect you? Unlikely, because it's considered similar to a living trust or land trust. to be the sort of trust that really doesn't block liability the way an entity does, an LLC or a corporation would. Now, let's say you're lending. Do you really need a checkbook LLC? Not for liability protection. I mean, how many people trip and fall on notes? Doesn't happen much. But John, I want it. I will get to that. I know what you want. I know what you want. The other situation where I think these really are necessary is you really need the funds the same day, and the custodian can't get you the money the same day. You need the money the same day. You're showing up at an auction, you got to pay right then and there. Otherwise, forget about it. And so the deal falls apart. And if the custodian, increasingly, I mean, the tech has over the years just gotten better and better, where the custodians are able to get you money faster and faster and cheaper and cheaper. That's another situation where I think a checkbook LLC is probably useful and worth the hassle. Take a look at the third bullet point. This is the real reason a lot of you get one. I want to do what I want. What? I want to do what I want, and I don't want to have to go through anybody, and I want to do it now. Well, yeah, you and me both, right? I want certain nocturnal arrangements with Salma Hayek that my wife and Ms. Hayek's lawyers have decreed unacceptable. We all want things we can't have or shouldn't have. So if the reasoning behind it is, well, I want the LLC just so I can get around the custodian and I don't want to deal with them and it's just fun and easy and it's cool and I can go play, that's not really a good reason, especially after this court case. Once again, not really an issue with 401ks. Now, if you're going to do a checkbook LLC, and I could do a whole half hour on this, watch out for sloppy operating agreements from checkbook LLC mills. Some telltales, there's never a discussion. What are you going to do with this? No, what does the operating agreement say? Do whatever you want. See, I don't like that. That's from any number of standpoints, both tax and non-tax, just legal as a best practice for a lawyer. I don't like that at all. Multi-member language. If they put in lots of vast, dense paragraphs that discuss things you don't understand, like 754 elections, 704B and 704C accounts, debt allocation under Section 752, none of that needs to be in a single member operating agreement. You know what that is? That is boilerplate that was cut and pasted. The author has no idea what it means, and it makes the agreement look a lot bigger and better, because bigger is evidently always better. Also, another sign is when they cut and paste the prohibited transaction rules. They just cut and paste. Yeah, you won't do this, and then they cut and paste it. I mean, have you ever read those rules? I get them now after years, but when I remember the first few times I went through those rules, those are not simple things, not something I would necessarily put into an operating agreement. That was my bad part. I'm telling you things you don't want to hear, but probably should hear. Getting any pushback on this, Jill?
We have a question. Can my son be the manager? Can my son be my checkbook manager for my LLC?
It's the same as you being the manager. Your son is a disqualified person, so you might as well just be open and out with it and do it yourself. I would really get a non-disqualified person, both from an optics standpoint, possibly from a legal standpoint as well. You can argue that your son is bound by the agreement. It's just really bad optics, at a minimum, really bad optics. By the way, that matters a lot. A lot of what I do, for example, I do a lot with asset protection as well and entities and maintaining them. A lot of what I do is designed to persuade someone, hopefully you never do meet, but if you meet, has a good impression of you, and that would be a judge. For example, maintaining entities, just under normal state level, non-tax asset protection concepts. Most of maintaining an entity is to create an impression with a judge you haven't yet met. And everything you do, including are you orderly, are you neat, do you keep things within the entity, do you have due to, due from accounts, does this entity pay your personal bills, does it pay bills for other entities, yada, yada, yada. All of this creates an impression. I'm not kidding when I tell people, get a fake leather binder, because real estate investors won't spring for real leather, with brass coated rings, because real estate investors won't spring for the real thing. And then make it nice and neat. And I give a big list of things that should be in there. And then take some spray, that new car smell. You can actually buy a spray and spray it. And I'm being half facetious. Why? It creates an impression. All these things are optics, and they create an impression. And that's a big part of the law, because if I have to represent you in tax court, knock on wood, I want you to be faster than 1 in 20 hikers. When you go to tax court, let me put it this way. When you go to tax court and I've screened the case ahead of time and I've told you you have a good case, because if you have a lousy case, it's a whole different matter. If you have a good case in tax court, your odds of settling with the IRS are about 95%. It's only about 5% likely you go to trial. Who goes to trial? The black and white case, which are the ones I screen for to tell you don't go to trial. This is a bad idea. What's my point here? You're creating an impression, and my planning, and when I think about what's in your operating agreement and who your manager is, et cetera, is aimed at that IRS lawyer. The IRS lawyer has far too many cases. She can only take 1 out of 20. I need you to be not that one person. I need you to outrun one person out of 20. You don't even have to outrun the bear. I need you to outrun one hiker. And so when I mention optics, that's why, because I know how these people think. This is something you're going to like. This is glorious and wonderful. So I told you things you did not want to hear. Yuck. Now let's get to yum. Converting at a discount. Let's go through this. Traditional. Everybody loves traditional, the deduction. Everybody hates deferred taxes, and especially in an inflationary environment. I'm going to do a graph for one of my short videos that shows just how much tax you pay on inflation and how that compounds over time. Traditional is deferred and compounded. In an inflationary environment where the nominal return is, say, 20% and the real return is, say, 11%, you're paying over just shy of half of what you're paying is on air. That hurts when it's deferred. This gives us an even stronger reason for Roths than we already had. My favoritism towards Roths has simply grown with inflation, because on deferred income, you are going to pay a huge amount of taxes on something that's not real. It's nominal. It's inflation. And so this matters, the ability to convert. How does a normal conversion work? Now, I'm just making up the numbers, so engineers don't get bent out of shape and send me emails saying, you can only convert 64,500 or 74,500 to your Roth. This is just a simple math thing for normies engineers and software engineers. Just calm down. It's all good. Take a Quaalude. If you're under 35, Google it. You'll know what it means. So you contribute $100,000 to a traditional. You get a $100,000 deduction. You then convert to Roth. You convert cash. You convert publicly traded securities. You add the $100,000 right back to income, right back to your 1040. It's a wash. It's a wash, unless you wait. The longer you wait to convert, the more income the traditional side develops, the larger the number you have to convert. Ouchie, ouchie bad. All things being equal, and they're not always equal. Maybe later your tax bracket will be lower. I don't know. That's what everybody thinks. It doesn't always work that way. In fact, with entrepreneurs, it seems increasingly to be the case. It never works that way, because you guys find meaning in what you do and you don't stop. And so the bracket never actually drops, even though that was part of the plan. But bottom line is this. You put 100 in traditional, you get 100 grand deduction. You convert 100 grand to Roth, you add 100 grand to income, and it's just a wash. That's just the way it works. Now there's a better way. Here, let me see if I can push one little button that makes that click, that little bleeping noise stop. All right. In estate planning, we have discounts that to estate planning lawyers are, this is like their bread and butter. They all know this if you talk to them, all of them. I'm going to give you an example of estate planning discounts because they apply for income taxes, including when you're converting from traditional to Roth. I have a home worth 200 grand. We stick it in an LLC that I own 50% of. Your interest is not worth half of that. In other words, if you go and say for tax purposes, hey, I own 50% of an LLC that has a $200,000 house, my 50% ownership is worth 100 grand. No, it's worth closer to 40 or 60 grand, which is a good thing. That's a good thing. Now, for estate planning purposes, it's good because the size of the gift that you're transferring when you have these discounts, I'm transferring a piece of an LLC to each child, for example. That discount is a good thing. You're using up less of your gift and estate tax exemption. So the two primary discounts, take a look at the fourth bullet point. If you are not in control of the LLC, which by the way, with syndications is always the case. Like there's nothing longer lived than a syndication manager, except for maybe a government program. Otherwise, that's just the most immortal thing in existence. So they're hard to get rid of. Bottom line is they have to do something really naughty on film twice and be voted out by a supermajority, including themselves. So getting rid of management is kind of hard. Also, so there's a discount for that. You are not in control. You are not in control. So you get a discount. The code says for estate planning, and there's case law that it says applies in the income planning standpoint, the courts have consistently said, yeah, that drops the value of this thing by 20 to 30%. Oh, good, I like that. Then the investment is not liquid. Now, private investments are not liquid based on their very nature. In other words, try and sell just in a syndication that allows you to sell units, try and sell one and see what happens. Who's going to offer fair market? Who's going to offer full value? Nobody on this call. Every one of you is going to be like, oh, you need cash now and this is not liquid and I got cash. Would you like to discuss a deal? That's what you're going to do. That's what everybody does. And the courts recognize it. Even better if there are poison pills in the operating agreement. If there's a right of first refusal, why would I as a buyer even bother to make you an awesome offer since I know someone else is just going to swoop in? Or maybe the operating agreement says a whole bunch of people have to agree and it makes it very difficult for me to buy. Well, that's a discount under tax law, another 20 to 30%. So the total discount just for this, there are other things. I've done 2-hour webinars on all the different kinds of discounts. These are the two basic ones. You add these up, just these two, 40 to 60% discount. So what do? You have a traditional, and it could be an IRA, it could be a 401k, whatever, a traditional thing. Let's just say it's 100 grand. You got 100 grand deduction for contributing to this traditional thing. You immediately invest in a syndication or some other small private enterprise. I use the term syndication very generically, but it could be a family LLC. The discounts would be smaller unless you could show your family is dysfunctional. There's actually case law that says if your family is super extra dysfunctional, you get a bigger discount. That's always fun to testify to. If you have an investment, the instant you put the 100 grand in, you get your write-off. Then you invest in this private thing, this thing with friends or a syndication. Then you go to and get a light appraisal, not a full-blown appraisal, kind of like a BPO. Usually runs you about $1,500 bucks. Most of these guys are going to give you a discount of 40 to 60%. What does that mean? Well, your interest is actually worth the instant you go from cash to investment. All this money, this $100,000 thing on the tax return is now only worth 40 to 60 grand. So let's be optimistic. Let's say I get a 60% discount. My $100,000 that I put in the traditional, I got 100 grand deduction. I convert to Roth at a 60% discount, meaning I'm only reporting 40 grand of income, but I converted all of it, all 100 converted, but I only had to report under law 40 grand. So I got to keep 60,000 of deduction, but the whole kit and caboodle is a Roth. And that, my friends, is super powerful. In fact, I was shocked when I first did this presentation on I do webinars twice a month. We'll talk about those later because it involves you giving me money and I'm a really big fan. I talked about this about 2.5 years ago. And my purpose was to show all the other types of discounts. I assumed everybody knew this. And the call just came to a screeching halt. And these were pretty sophisticated people on the call. And they're like, wait, what? I missed out on this? I didn't convert? Or I can, for me, it's a natural fit, right? I invest passively. I don't have the time anymore to go buy rentals and run rentals. And it was not something I was ever very good at to begin with. I'm much better at being a lawyer and drinking. But rentals make me want to drink, which again, I'm good at, but not so much better at the rentals. So I invest passively. So for me, this is a very natural approach. It's a very natural approach. Now the business has to make sense. Would I go dump money in a syndication so I can get a discount? Hell no. We never, ever let the tax tail wag the business dog. Business is always first. So it still has to be a good investment and it has to match your style. For example, I have clients who are very good at flipping properties inside of their self-directed accounts. They should have the account be Roth immediately. They should not put the money where it's tied up for 5 years and they're not making much because they can make so much more flipping, they should convert to Roth immediately and pay the full freight. It's worth it. So we always look at details and ask questions. We always ask, what are you good at? Is this a good fit for you? And that's tax planning. Tax planning is me coming up with a bunch of tax ideas, but some of them for you are terrible lifestyle ideas. A good example, back when I didn't live in Puerto Rico and needed write-offs, I wanted my wife to be a real estate professional so we could use the losses that I generated all too well on my rentals. And that would help my, offset my income from my tax practice. What was the problem? It would have resulted in my death, right? My wife did not wish to be a property manager, and my wife is uniquely able to express herself in a very kinetic fashion. Latina, all I got to say. So great tax idea, horrible, not just lifestyle, just life idea. So this applies here too. Don't run out and invest in a syndication just to get the discount. It has to make business sense. But if you do, oh my goodness, contribute traditional as fast as possible. Again, within the bounds of reason, a good investment, et cetera. Invest in something private. I use the term syndication generically. And then get a mini appraisal. I have a guy, and I'm in the process of getting several more because I've sent him too much work and he gets really busy, that will do a mini appraisal. So you have something to back yourself up in an audit. And make sure before you do this, talk to Jill's people, because every custodian has their way that they want you to communicate to them when and how much you're converting. So you got to know the rules. There isn't just the tax code, there's Jill's rules. You got to communicate and ask questions. Now, she'll happily answer you, but you need to do that ahead of time. Please, people, don't do this at the end of the year. Good Lord. I mean, if you're forced into it, that's just when the money showed up or whatever. But especially don't do the investment in, let's say, March, and then you're busy. I have things to do. And so you don't talk to the appraiser till December. Turns out the appraiser is really busy. Jill has forms she has to fill out by a certain date. She needs a fair market value. Don't mess around with that. Guys, this is powerful. This, if you haven't heard of this, this is more than worth the call. This is very, very powerful. We're going to talk UBIT and some ways to get around it. But first, shall we hear from our audience?
Sure. I don't have any questions on deck, but I have one sort of relative to this situation that was sent in previously. So let me read that question. It has to do with a discount. Nope, that's a different one. I invested in a startup using my traditional IRA in 2020. I'm 62. I also have a Roth, and it's been open for more than 5 years. The initial investment was 50,000 units at $1 per unit. I knew there was a good possibility for the value to increase to $5 per unit, so I converted the 50,000 units to my Roth at the dollar valuation in 2021. He probably could have done it at a discount too if he got an appraisal. But so invested using a traditional, converted the 50,000 to a Roth. In 2022, the value increased to $5 per unit. So now it's in his Roth at 50. It goes up to 250,000. Great. In 2023, the company took a turn for the worse. While the value is still at $5, I do expect the company to fail in 2024 or 2025. Can I take a distribution from my Roth at the current fair market value, 250? I have documentation from the company to say the fair market value is 250. It's not taxable now. I'm 62, and now I own the units personally. I distributed the units to me personally from my Roth. No taxable event. If the company goes under in 2024 or 2025, can I now take the $250,000 loss personally?
Yeah, actually, now let's assume just because the company said the value was X doesn't mean it's X. In other words, the IRS can challenge that value, okay? So the fact that you have a piece of paper that says, no, it was really worth 250, when you kind of know in your heart of hearts it wasn't, just be aware of that. IRS can always challenge value, always, on anything. But let's assume, for the sake of assuming, that it's out there at 250. You distribute at basis. So you have a 250 grand basis in that, assuming that's the actual value. If it goes to zero, Now you do get into what you want to have your accountant look at. There's a little bit of a distinction. Now we're getting outside of IRA law, but that's one of the things that, it's funny. There are some IRA specialists that all they know is IRA law. They're super, 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 super good at it. But there are contexts outside that affect inside. And that's where I'm really good because I do a bunch of other things. I mean, not to be too humble about it, right? So my wife's laughing at me. That was my reminder to pretend to be humble, but I'm not good at this. So when you take the loss on that, it will almost certainly be a capital loss, which is less useful than an ordinary loss, but still better than nothing. You want to make a decision between, do you wait for it to be completely worthless, which is a very hard threshold to meet, and the IRS likes to second guess you. I think it was completely worthless in 2025, and then they look at it and they're like, no, we think it was 24, you lose. Oh no, it didn't happen until 20, up, you lose, right? So one thing you might consider, and I actually did a webinar on it, there's a concept because it was coming up with some of the crypto and other stuff going to zero, abandonment. If you can show you abandon the asset, in this case, the stock shares, you have greater timing over the control of the loss. The IRS is less able to play the subjective game of, well, we think it was worthless at a different time. We're establishing abandonment. The tests are more objective. You want to have your CPA look into that concept. There are some decent recent articles on it because of the, now crypto's going back up. The prior crypto crash and some of the fraud as well caused people to try and time losses, and abandonment is a way that you may be able to do that. So good luck with it and good luck with your valuation.
Interesting. Thank you. This is,
Go
I have one more question, similar. So I have a solid relationship with my siblings. My brother did an investment for 25,000. It was risky and it looks as if he will lose his investment. Can I use my cash of 25,000 to purchase his investment? And if the investment does become worth it, can I take the tax deduction of 25,000? My goal is to get the tax deduction for giving him the money versus just giving him a gift. Would that work? I'm seeing you frozen on my end, John. Okay, we lost John, so he'll be right back. And then we're going to move into UBIT, unrelated business income tax.
Okay, am I back?
Yes, you're back.
Okay, let's reread that real briefly.
Okay.
I missed something in the beginning.
I have a solid relationship with my siblings. My brother did a self-directed IRA investment of $25,000. It was risky and looks like he's about to lose his investment. Can I use my cash of $25,000 to purchase his investment? And if the investment does become worthless, can I then take the tax deduction of the $25,000? My goal is to get the tax deduction for giving him the money versus just giving him a gift. Sounds like someone's trying to help out a family member.
Yeah, you've got some definite optics issues there. With almost everything you do when it comes to tax planning and structuring, you have to have a primary non-tax business purpose. Otherwise, they just ignore what you're doing. And there are other things. They can do substance over form and so on. So when they ask you, well, why did you buy this losing stock out of his IRA? And you say, well, I was trying to help him out. They're just going to be right away, yeah, okay, this is bogus. You can lie and be like, no, I actually thought it was going to go way up. I think he's wrong. He said it was going to go down. I thought it was going to go up. Well, you better document the heck out of that. Because once they see the totality of the facts, let's see, you can take a loss and are going to, and his IRA cannot take a loss, but now his IRA is replenished. Things that make you go, So I would say that's a hard one for me to defend. I'm not going to say no, it's gray as hell. But that would be a pretty tough one to defend.
Okay.
And you see why. I mean, it's just so clearly incestuous. And there's legal family financial incest, and then there's the other sort. This one, I think a smart auditor, I think, would see through it and disallow it.
Okay. I have another question kind of along those family incestual lines. I loaned my fiance $100,000 to buy a piece of real estate. It was secured. Terms were 6% for 5 years. The property needed much more maintenance than we planned, so my fiance has not paid the note for the past year. Technically, the loan's in default and could be considered uncollectible. Can I discount the note to convert to a Roth? What is a safe fair market value to discount? If the note does become uncollectible, who is responsible for sending my fiance a 1099? And what are the penalties if she's not sent a 1099?
A lot going on here.
A
I
lot.
mean, this is what keeps you from getting married, right? Baby, I can't marry you. I mean, now I'm lending to my wife and we have a prohibited transaction. And so until the loan is settled out and paid off, I'm sorry, baby, but the tax lawyer said we can't get married. And by the way, that's true. I'm not even being facetious for once. We see this a lot with financial friends. And usually I dig. Like, yeah, John, I got this loan that is going to hell and I want to convert to Roth. And I'm like, really? You've got this bad asset. Yeah, John, it's terrible. It's horrible. It's a bad asset. And you're going to pay tax to put that asset in a better place, in a Roth instead of a traditional. Yeah, because the asset really sucks. Okay. What's really going on here? In other words, it's almost a contradiction, very close to contradiction. It's definitely, again, very bad optics. Yeah, sorry about not paying you on the loan. And it could be real. I mean, you better document the hell out of it. It just seems suspicious. So you have an extra burden of documentation of here's what happened, here's why the payments aren't being made. And then the IRS will look under the cover or under the hood. They can. I mean, maybe we get the incompetent auditor, but can they look and see, oh wow, and somehow there was a movement of money from you to the fiance, and then oddly enough, your loan got paid back. Who knew? So I don't know everything that's going on, but I know that I don't know everything that's going on because I get these questions a lot. And when I start to dig, it just holds less water. I would say this: if you're going to choose this approach, document very carefully, contemporaneously, honestly. Never lie to those people. That turns money issues into freedom issues, unless, of course, you're politically connected. I won't say any names. But document, why is the loan worth what it's worth? I would probably go get someone to do a light appraisal on it. And then document where the funds came from if it just somehow manages to reperform. Be careful with that. I'm not saying no, I don't know enough facts, and frankly, I don't want to know, but I hear these a lot.
Okay. All right, we could go right into UBIT if you'd like.
All right, UBIT is actually pretty easy to explain the basic concept. Here's how I explain UBIT in one slide. Most of the time, your account internally is not taxable, except for when it is. And when it is almost always because of UBIT, unrelated business income tax. A silly name, where did we get it? Because this was initially applied to charities who were competing with business but not paying tax. So let's say the university set up a Dairy Queen. The actual Dairy Queen across the street said, whoa, university's not paying tax. What's up with that? And so Congress created a tax that said, listen, university, the Dairy Queen people have a point here. And so when you have a business that's not related to your purpose, and it has to have more relationship than the money helps our purpose, when it's unrelated, we're going to tax you, and we're going to tax you good and hard. So for example, with the university, maybe a bookstore is related, or maybe dorms are related. I don't actually know. I didn't look. I don't care. But I'm giving you ideas of where the name came from. Three things with an IRA cause UBIT. First of all income, there's never unrelated income with regard to an IRA, or related income with regard to an IRA. But three things cause UBIT. The account renting out personal property. So it could be automobiles, furniture, meth labs, non-real estate. It's renting out personal property. That causes UBIT. Second, the 401k or IRA runs a continuous trade or business. Now, usually that means selling inventory, which can include land and houses. Selling inventory, in other words, you sell something enough, and the threshold for UBIT's fairly low. You sell enough of something that it's considered to be continuous. It's inventory. Or you provide services. And the third thing is borrowing. So anytime one of these accounts borrows, you have an issue of any profits generated from the borrowing are taxable. For example, account buys a house for 100 grand, puts 10 down, borrows 90%. 90% of the net rental income 90% of the gain on sale are taxable. That's a very crude example, just to illustrate the point. Now, remember, what happens in a syndication, unlike Vegas, does not stay in the syndication. It's passed through. So for example, if your LLC invests in a syndication, even if it's only a 0.00001% member, whatever the syndication does, your IRA did. So if it borrows, your IRA borrowed. If the syndication has a Dairy Queen, a continuous trader business, your IRA has a Dairy Queen, a continuous trader business. Be aware of that. C corporations are different. When you invest in a C corporation, it's a little bit more like Vegas. Everything but the VD stays in Vegas, and the C corp, everything stays inside of it. And that's why we call it a blocker, right? And not a pass-through, it's a blocker. It blocks UBIT. So if you invest in a syndication that's structured as a C corp, now if the syndication borrows or has a continuous trader business, there's no UBIT. Now the C corp still pays the internal tax rate. In fact, one of the strategies to reduce UBIT, it won't eliminate it, but it'll reduce it. Let's say your IRA, and I use the term generically, it could be your 401k, it could be your HSA, whatever. I use the term throughout this presentation generically until I indicate otherwise, because you don't really want to hear me say your IRA, SEP, simple, HSA, 401k, that hurts. So we're just going to say IRA. When your IRA invests in a trader business, a Dairy Queen or a law firm, so an ongoing trader business, the Dairy Queen, what does it do? It sells inventory. That's a continuous trader business. The law firm, what does it do? It provides services. That's a continuous trader business. Doesn't matter if it invests directly, the IRA owns it, or through a syndication. The syndication does it, the IRA owns a piece of the syndication. You got UBIT. And UBIT is at a very high tax rate, typically 37%. If you throw in state tax out in California, you might get up to 50%. It's a very high tax rate. The reason you might use a blocker, let's say I'm buying a Dairy Queen. I would buy it in a C corporation. Why? Because if I use a C corporation, we only pay the 21% corporate rate on this ongoing trader business. And we don't pay the 37% UBIT. That's a 41% tax savings. So blockers can be very useful. Now, here's something I hear all the time. 401ks don't pay UBIT. Wrong. 401ks follow exactly the same rules as IRAs for UBIT. Exactly the same, with one important exception. If the only thing that is causing the UBIT is that the 401k or other qualified plan borrows on real estate, so it has to be secured by the real estate in order to acquire or improve real estate. So on real estate, to acquire or improve real estate, a 401k will not pay UBIT if that's the only thing causing UBIT. An IRA or an HSA or other plans that follow the IRA rules will pay UBIT. So that's one huge advantage of having a 401k. If you have traditional IRA money and you're getting ready to invest, for example, in a leveraged apartment syndication, roll the money to a 401k first, because then you won't pay UBIT if the only thing that causes UBIT is borrowing secured by real estate used to acquire or improve real estate. Now, let's say the borrowing is secured on real estate, but I buy Bitcoin with it. No exemption. Both the IRA and the 401k would pay UBIT in that circumstance. So 401ks in that regard can be very powerful. John, I don't qualify for a 401k. Oh my God, it's so easy to qualify for a solo. Go out, sell $2,000 worth of stuff, net profit. So 2,000 net profit on eBay or wherever the heck it is people sell stuff now, because I'm a dinosaur technologically. I don't know where you sell things online, like the dark web and where you buy drugs and social security numbers. I don't know. But you go and sell stuff, $2,000 of net profit. You now have a trader business. You don't need to go set up an entity, just have a separate bank account. You have a trader business, hopefully producing roughly $2,000 every year net income. You qualify for a solo K. Oh, but John, I can only contribute $2,000 a year to it. Well, that wasn't the point. I have a $5 million IRA I want inside the 401k. 401ks are generally better than IRAs for any number of reasons. Prohibited transactions are penalized less. This UBIT rule is nice if you're investing in leveraged real estate, et cetera. So you probably can have a solo K. Now remember, you can only move traditional IRA money to a solo K. You cannot move, under present law, Roth IRA money to a Roth 401k. And why not? Because Congress said so. Why did they say that? They probably don't even know. I certainly don't. So there's your basic explanation of UBIT.
Perfect. John, I think when you came back, you turned off your camera. Can you turn your camera back on?
Oh, sure. It's just this
Thanks.
disembodied voice without all
Yeah.
the sort of
Yeah,
Youngstown
you
Italian gestures.
I,
It had
uh,
it had me on. Can you see me?
I can't, maybe everyone else can. I see this quite a bit where folks are investing in some sort of syndicate. I get the K1, I can see that there's leverage and they're not doing a 990T is the form that you would fill out to pay your UBIT. And this is something that I wanted to share too. Your UBIT, keep in mind that anything that your IRA does, any expenses associated with that asset need to come from the IRA. So when you do have to pay the UBIT tax, you need to have your accountant fill out the 990T, which is the form, and then send it to us to pay the tax out of your IRA. So that's how it's done logistically with iPlan with respect to paying UBIT tax to the IRS.
Yep, I agree. And hey, can somebody say if they can can someone see me? Because I can see me. It says my camera's on and
Oh,
I can see
perfect.
me moving around and doing things.
Yeah,
Okay.
John, it's definitely not showing you, but it's saying the camera is on.
In the upper
Oh,
right.
there you go. Let me see if
Can
there's
you
anything else.
try clicking if it gives you a drop down next to the camera button?
No drop down, but that's
No
only because I
drop
have the camera on the computer itself. I turned it off. See, now the camera's off. Now the camera's back on. Let me see. Oh, let's see. What are the little dots here? Oh, no, they don't say anything. Don't know what to tell you. I am a tech
Okay.
like ignoramus.
Yeah, I'll poke around on the back end and see if it's something I can do from my end.
So all these gestures and facial expressions and this Jim Carrey-esque mask have been for naught.
Exactly.
I'll have to use more inflection. This is horrible. Okay, so shared appreciation mortgages. I love these. This is most common when we see people financing, instead of using a JV, let me back up a minute. We got a guy with money, IRA. We got a guy with time, flipper. If they joint venture, what are some of the problems? The IRA may have to pay UBIT because you have a joint venture. A joint venture is a partnership. Jill and I do a handshake. I bring the money, she puts in the time. We have a partnership for tax purposes. Everything that happens in the partnership, including buying and selling, is attributed to my IRA. So there's a chance of UBIT there. There's also liability. Even if I have a checkbook LLC or if we're investing through an LLC, you have some liability protection, but it's like a bulletproof vest in LLC. It's not perfect, right? It's better than cotton in a gunfight, but if you get shot in the face, the vest doesn't really help you. So they're imperfect vehicles. I like the lending. Why? When we lend, there's no UBIT. The only way to generate UBIT when you're lending, this is really important. The only way to generate UBIT when you're lending is to borrow and then lend. But no matter how large the trader business, I get this question all the time. I have a trader business of lending. I lend $3 million a year in my IRA. And my accountant says, because it's a trader business, because remember on the UBIT slide, trader business, taxable, right? UBIT taxable. Well, but there is a revenue ruling that says accept interest, because there's an exemption for interest and that trumps the overall trader business. There's an actual revenue ruling. It was a foundation that actually had billboards advertising lending, and they loaned out, I mean, just millions upon millions upon millions of dollars. And this was back in 79 when that was real money. And the IRS came back and said, no UBIT, because the interest exemption from UBIT trumps the taxability of a trader business. So if you're in the trader business of generating interest, lending, the interest portion trumps, which is good. So what do we like to do? A shared appreciation mortgage. The IRA lends the flipper money. The interest rate is not 10% and 2 points or whatever. It's a percent of the profit. It's a percentage of the profit. So for example, very common is 50% of the profit, or 6% interest, or 50% of the profit, whichever is greater. Now, what's key when you do this is that you don't want to draft the note so that the IRS views it as a partnership. That's a problem, because then you're back to your JV land and you have potential UBIT. You want to make sure, there's case law on this, you want to make sure the note has all the other attributes of a note, so that your one weird attribute that we're measuring interest based on profit doesn't blow the note and turn it into a JV. So you want to make sure you have a fixed, clear term, some collateral. The lender does not share in losses. The lender doesn't act like a partner by, say, being on site and bossing everybody around. They actually act like a lender. This is harder with long-term deals because of prepayment penalties. In other words, I want to have 50% of the rentals for 30 years. Well, what happens if your borrower prepays? They think it's going to go up in value. So after 10 years, they have enough money, they prepay your note. Well, I'll put a prepayment penalty. Well, given the appreciation on rentals, especially in an inflationary environment, that better be a vicious prepayment penalty. What's the problem with that? Now it starts to look less like a note. Now we have another oddity, something weird, this really draconian prepayment penalty. So just some thoughts on that. We draft a lot of shared appreciation mortgages, and it's usually on somebody's flipping something, not always real estate. We've had people that go to government auctions and buy stuff and flip it, and someone else funds all of that out of an IRA. We've drafted shared appreciation mortgages for that. But they do have to have two lawyers involved. A tax lawyer who understands when will the tax court view a document as a partnership versus a loan. Because remember, the IRS can always overlook your paperwork and say, look, this is what actually happened. We care about what actually happened. We don't care about the words on the piece of paper. And so you have to make sure that your loan doc is actually a loan. This is one of my favorite strategies. I love shared appreciation mortgages. Some states, because the other lawyer you need is a local lawyer to tell you it's actually legal in the state you're in. This gets interesting in Texas, because in Texas, they have a hard limit of 18% on even commercial lending. So now we have to get a little more creative and do options and more moving parts, basically, which is good. More billable hours for the lawyer, which I think is always a great thing, but others may not agree. Can you guys see me yet? Or can I do funny things? I wonder what's up with that.
Might be a connection issue when you got kicked off and came back on.
That must have been it. Oh well. I mean, maybe it was the internet's way of saying nobody really wants to look at Hyre.
Does your camera icon, John, does it have a slash through it, or is it just a blue camera?
It's white, it's not blue, but there's no slash. When I click, there's a slash. Like I click now it's white with a slash. Then I click again and it's white, but no slash.
I'm not sure. I will keep looking around, but all the settings say you're clear for camera.
Okay, well, we'll just move along. I mean, hopefully the voice just does it. Back to the days of radio. You have a face for radio. Great, congratulations. So here's an example. This is a very common shared appreciation mortgage. Bob's IRA makes a loan to Flipper Joe to buy, rehab, and sell a specific property. The loan is due in a year, and it could be 2 years or whatever you decide, and it has a clear interest rate, in this case, profit, which, by the way, needs to be super, super carefully defined. One of the things I always put in there, for example, is that no expenses are legit unless they're paid to a third-party vendor. In other words, they can't pay themselves consulting fees to drop the profit or something bogus like that. So the interest rate equals profit percentage on the resale of the property. If the property is not sold in a year, and this is just my example, the interest is 50% of the appraised value minus costs, of course, in other words, the appraised profit, or 18%, whichever is greater. The loans are always secured by property. Construction draws are permissible. Why? Because in a normal loan, construction draws are permissible. That's not partnery. That's what lenders do. And as I mentioned, I do want a local debtor creditor lawyer taking a look at it. I also like, by the way, here that creditors have less liability than partners, even if entities are involved. And what I really love is just no UBIT. It's interest income. I love that. That makes me so happy. And let's see, borrowing via an IRA. This will go pretty quickly because I think it's pretty straightforward. And guys, number one tool for making a small IRA into a large IRA, borrow. Oh, but I have to pay UBIT. So what? Now you have a large account with a bunch of money. You do 1 or 2 or 3 deals. Let's say you need critical mass. John, for my IRA to do a deal on its own, it needs 200 grand. We'll borrow until it has 200. And then once it has 200, it can do deals on its own. No, I refuse to pay tax as a matter of principle, John. I want perfection. Well, Voltaire said quite rightly, the perfect is the enemy of the good. By the way, people might think about that with politics as well. The perfect is the enemy of the good. There are attainable things attainable by actual living humans, and then there's perfection, which none of us ever reach. I see these schemes to grow small IRAs into large ones. My favorite that will die in tax court. I found a property and my IRA put $1,000 on a contract, and my IRA found a house. And no, it didn't. Your IRA is a piece of paper. You found a house. And then my IRA paid $1,000 for a contract. Okay, that part I believe. And then my IRA went out and found a bunch of buyers. No, it didn't. It's a piece of paper. It doesn't do anything. You do. And then my IRA sold it to these people. No, it didn't. You did. Now you had to have the ownership. What's the problem with that? By the way, this is very widely publicized as an acceptable way to make little IRAs big. You are dead in tax court. There is a tax case called Mazzei, M-A-Z-Z-E-I, that came out about 4 years ago, and I was one of the few people to write on it. And I don't like it, but again, it pretty much said when the IRA puts in a tiny amount of money and almost all of the value added comes from the human, the income belongs on the human tax return, the 1040. We see this, by the way, if you change the word assignment to option, same result. Same result. Changing the word means nothing. Here's another context. You're not going to like it. Wrapping a note. John's IRA has $1,000. Bob's IRA, Bob has $99,000. Bob's happy to lend at 6%. John found someone that will borrow at 15%. John's IRA takes $1,000, wraps Bob's $99,000, lends out $100,000 at 15%. John is smart and creative. No, John is dead. Was the $1,000 what made the difference here? Honestly. And then you can make all the arguments you want. No. You know what made the difference? John's effort put in the most value. Oh, so John's not allowed to exert any effort. Well, no. At some point when the IRA puts in enough, I think the court would say, you know what? That's enough. And here's my number, by the way. It's totally made up based on the Mazzei case. If I were an IRS lawyer, which case would I not want to take? The one where I'm wrapping with 20%. In other words, the IRA comes in with 20 grand. Bob comes in with 80 grand at 6%. The IRA uses 20 grand to wrap 80 and rents or leases out the whole darn lease. I mean, I'm not on camera, and so I start slipping on words. Lends out the entire amount at 15%. I'm fine with that. I think I can defend that. I don't think an IRS lawyer wants to take it to court. Why? What's the difference? Because the IRA has significant skin in the game. 20 grand, 20% of the deal, that's my metric, 20% of the deal is real money. 1% of the deal, all the value is coming from the human, and the income will go on the human's return. By the way, there's a lot of case law on this in a non-IRA context. In Mazzei, all the tax court did was apply it to an IRA. Here's an example. John bills you for stuff. Let's pretend John lives in the States and gets taxed a lot. Horrifying thought. John doesn't want to pay those taxes. So I tell the client, I say, hey, Jill, can you write the check to my grandma? She's in this tiny little bracket. This would be so cool. Let's do this at grandma's bracket. Well, there's a ton of case law that says, whoa, John did the work. We're going to tax the work where the work was done, and that's John. This is the same thing. The IRA putting $1,000 into a deal did not make the deal happen. It did not add the value. The human added the value. Now, at some level, once the IRA is put in, quote unquote, enough, and my number is 20%, just my sense of after dealing with IRS lawyers for 27 years, they're going to be like, oh, I think you're the 19th hiker. Damn it. I'm going to go eat the 20th one. You got to have enough skin in the game that it's credible. Give you one more example of it to what to watch out for. My IRA partnered with this other guy. This other guy put in 100 grand. My IRA found a deal, and it got half the money because my IRA found the deal. Once again, your IRA is dead tree. It does nothing. You do things. And it's acceptable to do things if the IRA has enough skin in the game. In this example, it has no skin in the game. That's dead on arrival. Why do I love borrowing to grow little IRAs? Because it works, it's simple, and with the IRS, you can even show them, and it makes a psychological difference. darn it, you guys got me for some tax. But if you look at the tax over the life of the IRA, it's going to be very, very low. If you grew the IRA very quickly to where it could do its own deals and you paid a bit of tax to do that, now that it's big enough to do things on its own, can you more than make up for the tax you paid by the fact that the IRA accelerated achieving critical mass? That is such a key concept. If you borrow, you pay a little bit of tax. It's not perfect, but you get to critical mass much quicker. And now the IRA can do things on its own much quicker and be generating far more tax-free income. That is very good. The perfect is the enemy of the good. Accept the good, embrace the good. When you borrow in an IRA, let me give you a little hint here that I haven't heard any other speaker. Jill, I'm going to ask you if any other speaker has said this, among other things. Custodians tell you, because they want things to be understandable, that you have to borrow non-recourse. And that's true, but there's a narrow exception that I'm going to talk about. The reason custodians will tell you, all of them, every last one of them, with good reason, that it's non-recourse is because if you personally guarantee debt for your IRA, it's a prohibited transaction. And they don't want you going within a country mile of a prohibited transaction. However, if you can get a non-disqualified person to guarantee debt for the IRA, and the IRA pays that person a fair fee, there are actually people who will guarantee debt for a fee. They do this for a living. You find out what would they charge. You pay some friendly, non-disqualified person to guarantee the debt. When is it worth it? Let's say it's a large loan and it drops the interest rate by 2 points and you only have to put 10% down instead of 40% down. That might be worth paying somebody a fee. Now, you have to pay them a fee and you have to document it's a market fee. Why? Because if, let's say my friend guarantees debt for my IRA personally and he does it for nothing because he's my buddy, that's a big mistake. Because here's what the IRS is going to argue. And by the way, they're going to win. They're going to argue that it's indirectly you're the puppet master, your friend is the puppet. In fact, when they call your friend to testify and ask them, do you guys have sort of an informal understanding that if things went bad, that John would be the one showing up ultimately to make you whole for the guarantee, personally and directly? And he would say yes, because otherwise he wouldn't do it. And if he says, yeah, actually, I did this for free because I love John, then the IRS is really going to dig. Who does that? Then they're going to say, all right, what did you get? What did John give you? What's going on here? That's just too suspicious. But if you find a non-disqualified person, even better, let's think of the narrative. What's a better narrative? I found a non-disqualified person, is a friend of mine. I paid them. They happen to be a hard money lender. Is that a good narrative? I like that narrative. Why? They're into lending. They understand lending. And they presumably would charge you a fair fee to guarantee. Let's change the narrative. My brother guarantees for a fee. Yeah, that right away, let's say you end up okay, you win. Way more likely the IRS is going to dig into it. Why? Bad optics. Bad optics. And worst of all, my brother guarantees for no fee. But now it's clear what's going on. He's just your cat's paw. He's just your cardboard cutout. Right? So that, and let me see, I have one more substantive slide before the propaganda, and then we'll just do Q&A. Borrowing from others. I generally do prefer private lenders. They're much more flexible. And I really like enders. So just drop off the L. I like enders as lenders. Why? Because at that point, they're passive and they're willing to take a lower return if you give them good terms. You know, you have a good history, you have a good credit rating, they're getting a good LTV, et cetera. Make darn sure that lenders are not disqualified as to the IRA. And those rules are subtle. Let me give you one example. We don't have the time to discuss all the disqualified person rules, but let me give you a subtle example that nails everybody. Jill and I shake hands on a deal. Jill, you know, you're going to do the work and I'm going to provide the money and you're going to go get something and make money on it. And we're going to split the profits. We shake hands. Now, obviously, as a lawyer, I don't recommend that approach. I like paperwork and clear contracts and LLCs. but we know each other. So let's just say we do a handshake. We have a partnership. Jill is now disqualified as to all my retirement accounts. Why? An entity that is 50% or more owned by a disqualified person or combination of disqualified persons is itself disqualified. Let me repeat that. An entity that is owned 50% or more by disqualified persons is disqualified. And anyone who owns 10% or more of the entity is also disqualified. All right, let's backtrack. 50-50 handshake, Jill and I. That's an entity. Under tax law, that's a partnership. I own 50%. So the partnership is itself a disqualified entity. Jill owns more than 10%. In fact, she's all the way up to 50% of owning this disqualified entity that we created with a handshake. She is now disqualified as to all my accounts. So be careful. Those prohibited transaction disqualified person rules are subtle, and there are hidden traps. P.S. Unsecured loans with no personal guarantee out of an IRA are absolute insanity. If someone would even ask you for that, I would think you're dealing with a ripoff artist just right off the bat. Don't do that. In fact, I wouldn't do anything with someone that would even ask that. That's just lunacy. Because what is that? An unsecured loan with no personal guarantee means there's no way to force them to pay. They'll pay if they feel like it. That is lunacy. And have I seen it? Absolutely. I've seen guys go to real estate investor associations and stalk the room for IRAs, kind of like the guy at the bar that hits every chair with a woman in it, just every single one, figuring someone's got to say yes. Same shtick. Goes to a RIA and just starts asking everyone who he thinks has an IRA, will they do this insane deal? Don't do it. Last slide, the propaganda, then we'll just go to straight Q&A. Guys, I do 2 webinars a month. If you like the style here, I present, what happens is the first Wednesday of the month, 7 p.m. Eastern time, for 2 hours, I pick a topic. Very often IRA related, but we do a lot of different topics. Some of them are really awesome, and some really end up being bad, because sometimes you don't know going in. Sometimes you hear about something, you pick a topic, and it turns out to be a dud, and sometimes you get a surprise hit, but we hit a lot of topics. The second call of the month every month is pure Q&A, raw 100% Q&A. I was preparing today for the one next week, and that's a lot cheaper than having me on the clock. Now, it's not the same. On the clock equals legal advice. On the webinar equals education, but it is a good way to get some information and get access. Puerto Rico, April 20th and 21st, self-directed IRA class, lots of Q&A. Jill, you've been to one of those, I believe.
Yeah, yes. They're
Lots of
excellent,
back
great
and forth.
information.
Thank you, because half of it is back and forth. I leave half the class time for Q&A, discussion, etc., and not at my rate of $1,000 an hour. So if you go to the website, it's right there, taxreductionlawyer.com. Those are the 3 things I do, right? The webinars, Puerto Rico, and oh yes, I bill $1,000 an hour. Well worth it. I do a lot of IRA work, a lot of planning work, by the way. The main piece of work I do is people will come and say, we're sending you everything. QuickBooks, entity structure, IRAs, investments, balances, personal vision statement, access to the QuickBooks, prior tax return, you name it. And then I go through it and I look for tax savings and entity structuring. That is one of the most common things I do. So that's enough about me, which I think for a lawyer was, I don't know, not horribly immodest.
Thank you, John. I've got a couple questions I'm going to start with. There's a deal that's going to be happening. Let's say it's you and I are going to do a deal. You're going to use cash. I'm using my IRA, or 50-50 for a real estate deal. In our agreement, am I allowed as the IRA, can the operating agreement be stated in such a way where the person using the cash gets all the depreciation expenses, and the other 50% that has the IRA does not take 50%? So in other words, the operating agreement
I get this question
gives
a lot.
Yeah.
I get this question a whole lot. Let me give you 2 versions of the answer.
Okay.
Let's start with the actual question. No, because it's solely tax driven. Oh, my IRA can't use the depreciation John's IRA can't use it. Why don't we give it to Jill? There is an absolute ban for the accountant types on the call, 704B and substantial economic effect. Section 704B as in boy and substantial economic effect, kill this deader than chivalry. Let me change the facts a touch. Jill and John are partnering personally, and they have an LLC. John's doing all the work. Jill's putting in all the money. Can we allocate all the depreciation to Jill? Yes, if we come up with a non-tax business reason that is primary. And the typical one in this case is, well, you're putting up the money. Shouldn't the depreciation deductions that the money generated go to the person who brought the money? Likewise, let's say Jill guarantees some debt. And then in the operating agreement, we give her all the interest deductions. Well, it makes sense. She guaranteed the debt. She's on the hook economically. So economically, shouldn't she get the tax benefit? We can do that. In an IRA, 704B will kill it. So good question, and I get it a whole bunch. So you're a good person, you're thinking the right way, but the IRS is 101 years old and they've had time to write regulations stopping some, but not all of your good ideas.
The next one is about HSAs, which we didn't discuss. I love HSAs and I think they're the most underutilized account.
Agreed.
Someone has an HSA. They are growing it just using real estate. They are not taking any distributions from the HSA to pay for medical expenses. However, they are accruing the medical expenses. So they accrue medical expenses for 5 years, but they're growing their HSA for 5 years. After 5 years, can they submit old receipts to pull the money out of the HSA?
Oh yeah, this is classic. And I agree with you. First of all, HSA, put money in, get a tax deduction. Get a tax deduction in a great place on your 1040, because not all deductions on the 1040 are equal. And then it comes out like a Roth. And the list of things you can take as HSA expenses, swimming pools if prescribed by a doctor for a legitimate reason, elevators in the house prescribed for a legitimate reason, properly structured medical tourism. I did that. I went to Chile for sinus surgery. It cost me about 20% of what it would have cost in the States, et cetera. So yes, and the strategy, here's the strategy. Put at least $100 in your HSA, assuming you qualify. What does it take to qualify for an HSA? You have the right kind of insurance. It's that simple. We won't even get into the details. It would just bore you. Just go to your insurance person, whoever that is, and say, look, I want to see your HSA qualifying policies. And they are either acceptable to you or they are not. If they are, and you choose to sign up for that insurance, you now qualify to contribute to the HSA. Put at least 100 in the HSA right away. Even if you got nothing else, the day the HSA is up, put 100 in immediately. Why? Because all health expenses that you pay personally and keep a receipt for, I would keep an Excel and I would keep multiple receipts, like backed up in 3 different places. Be paranoid, because the IRS, their number one weapon against you is no receipts. You need bank statements and receipts. That is not or, that is and there's plenty of case law on it. So what happens? You put $100 in your HSA. What does that trigger? All expenses that you incur for eligible medical costs, and the list is huge, from that day forward, may one day in the future, with no deadline, well, there is a deadline, a year after you die. So up to a year after you die, the HSA may reimburse you. So you want the clock ticking sooner, right? The sooner you put $100 in, the sooner expenses start to qualify. You keep a receipt in a spreadsheet, back it up in 3 different places, leave notes for your kids. Then when the HSA is quote unquote big enough, which by the way, for most people, it's going to be more like 20 years or more, grow the heck out of the HSA. Don't ever distribute money for healthcare costs until it is quote unquote big enough. My goal for my HSA is 5 free and clear rentals. I want 5 free and clear rentals. Then I will consider reimbursing myself for years and years of things that I paid for personally and have documentation for it. Let me give you a hint. Do not ever give those expenses to your accountant. If you give those medical expenses to your accountant will put them on Schedule A of your Form 1040. And oftentimes you get no deduction or a tiny deduction, and you have now destroyed your ability to be reimbursed for those particular expenses by your HSA. So do not ever give those health expenses to your accountant unless you intentionally wish for the HSA to not reimburse you in the future.
Thank you. This one came up today for us.
And then
We have-
real quick, I do see we have some people raising their hands in the chat. If you guys could go ahead and post your questions over in the Q&A, that way we can go through them and try to get as many people answered as possible.
And
Thank
Jill, I'm
you.
not in a hurry. If you want to go longer, I'll go longer if there are enough questions. But if you don't
Okay.
want to, then that's cool too.
All right, I think we have 4 more questions. So I have 1 million in my traditional IRA. I would like to buy a property in El Salvador. It will be a resort and I'll be staying in one of the units when I go down there. I understand. Yep, I understand this would be prohibited. I intend to loan the funds to my fiance and allow her to buy the property. We can stay then in one unit, right? Yes.
No,
No?
no, here's why.
She's a
things.
fiance.
Right, but it's an indirect. Here's the example I use. We're real close.
Okay.
Slightly off color, but you know me. The example I use in class is if it's indirect. So you cannot use the assets of your IRA to benefit any disqualified person, no matter how indirect the benefit, and the burden is on you to prove no benefit.
Mm.
So if you stay in the unit, you're still benefiting. The fact that you funneled it through your fiance makes no difference whatsoever. The IRS, it's in the statute, indirect. And if you look at the case law on how they interpret indirect, man, do they really interpret it hardcore. P.S. I'm half Salvadoran. I haven't been down there since Bukele cleaned things up. But man, if you're going to have a dictator, that's the guy you want.
The next part of this, so let's disregard, we're buying a resort. We're not going to stay in it. We
Cool.
loan the money to the fiance. Now we want to get married. We have to undo that transaction prior to the marriage, prior to the I do. However, what if I got married in El Salvador instead of in the US? Am I still disqualified if I'm married in another country and not the US?
Almost certainly. I'd have to double check the rule, but I'm
Okay.
fairly certain that marriage in another, in fact, I know this. What am I thinking of? I got married in Chile, according to my mother-in-law, January 1st. That was the church date of 1994. And for the IRS, December 29th in front of the mayor of Santiago de Chile. So yeah, the foreign marriage counts.
Okay.
And yeah, I was still in law school. It was funny. There's a story there. Because my mother-in-law went through great pains to make the wedding happen. It was actually in Viña del Mar, to make the wedding happen on January 1st. And then I'm like, listen, I want you to be married in 93 because we get the married filing joint deduction. And my wife got really angry. It's not the first time. And then I explained, I said, here's the size of our refund, single and married. And that's how much I'm spending on our honeymoon. And then she said, all right, let me talk to my mom. And then we came up with a solution that we got married in front of the mayor of actually Viña on the 29th. And then we got married in church on the 1st. But yeah, that marriage counts. So
Okay.
nice try. But no, you got to undo I guess the loan is moot because the whole purpose of the loan was to allow you to stay there. And of course, the next question will be, well, how are they going to catch me? Guys, I've done these audits and they can go pretty deep. They ask people. Now, it's a little harder in El Salvador, granted. But I had one audit where they actually asked contractors, how often do you see the IRA owner? And when you do, where is he? What does he do? So they started calling witnesses. Now, that's not very common because it's a lot of resources. And I think it would be very amusing to watch IRS agents go to El Salvador and ask this question, especially if the dude they're asking has a tattooed face, but that's a different story.
Perfect. Now, Bernie, I see that you have your hand raised and I've allowed your microphone. If you want to unmute yourself and ask your question, we can have John answer it. Bernie, do you still have a question? Oh, let me look. I have some more here too.
We drove him off.
Yeah, yes. And then let's see. What percentage of an LLC can I own personally, but also invest with my IRA?
That's always a dangerous thing. It's not that you can't do it. It makes the burden of proof harder and it's bad optics. The real thing you got to watch out for is this. If if you needed your IRA to get into a deal, here's a simple example. There was a property for 100 grand. I had 40. The IRA came up with 60. Otherwise, I couldn't have gotten in the deal. Then you just had a prohibited transaction because you were using assets of the account to benefit you. In this case, bootstrapping you into a deal. And remember, the burden of proof is for you to show that's not what you were doing. So if you're going to do that, I prefer not. I like simple, and simple is partner with others, borrow from others, etc. But if you're going to do that, you need to have contemporaneous, which means the day you made the deal, documentation showing you could have done the deal on your own. You did not need the IRA. You brought it in because it was a good deal. I would note that saying the IRA made money on its own is no defense. In other words, I had 40 grand, I needed 60, I brought the IRA in, and boy, did it make money. That doesn't matter. It's utterly, utterly irrelevant. So you have to prove you did not need the IRA to do the deal. And if there's a tie, the IRS wins. They always win the tie.
With that exact example that you just gave, say someone actually did that deal, and so it's gray area, or they're trying maybe not to get audited. And so a technique that they use is they did that on a real estate deal. They left that one asset in that one Roth IRA or whatever IRA it was. And then they just opened a second IRA to not taint the second IRA. Is that a strategy?
Yes and no. Let me clarify and split the question in two.
Okay.
If what you literally said is they open a second IRA and it has its own new money, then the first deal, let's say the first deal goes south, it won't taint the second IRA if money from the first IRA was never rolled to the second IRA, which was implicit. I think that's how you asked the question. Now let's switch the facts a little, because there is this kind of old wives' tale out there of, well, when I move my IRA from one account to another, or from one custodian to another, that cleanses the new IRA. No, 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 no. And again, it's the deal's not fatal in and of itself. You have complexity, which, by the way, what's the normal exit on that once I tell people this? Once that particular deal unwinds, get your money back. Now the IRA has a bunch of money. Hopefully you don't need to invest together anymore. Hopefully you don't need to invest together anymore. It's much better when the IRA can either partner with non-disqualified people. And here's what's really sweet: when you can get the non-disqualified person to take a preferred return, say 8% or 9%, because then what have you got? You got cheap financing, but it's not debt, so there's no UBIT. Let me repeat that. You partner with a non-disqualified person. IRA brings at least 20%. Remember our rule, it has to have skin in the game. So let's say the deal is $1 million, the IRA shows up with 200 grand. A bunch of other people, assuming that you follow all the securities laws and everything, not my area of expertise, they bring 800 grand. They take an 8% preferred return. Probably in this environment with high interest rates, they'd want more. But let's go with 8%. You make a ton of money. They get their 8% in their capital back. The IRA keeps everything else. That was just leverage, and it was fairly cheap leverage, but it was not debt leverage. Therefore, there is no UBIT. It was cheap equity leverage, and that makes all the difference.
Beautiful. Cheryl or Lakshmika, if you have questions, I've enabled your microphones to ask the question. Here we go.
Hey, thank you. I was not able to post the question for some reason, but thanks for unmuting me. My question is, I have very less funds in my IRA, but I have more funds in my invested elsewhere, which is not tax efficient. So I want to move the funds from a non-tax efficient to the IRA, or I like the idea you mentioned about the borrowing the funds within the IRA. So can you help me in structuring how we can move the funds from a non-tax advantage account to a tax advantage IRA?
I'll become a billionaire if I come up with an answer to that. In other words, how can I take my money that's not in the IRA and put it in the IRA? Well, there is one way I can think of off the top of my head. It gets complex and I don't discuss it much publicly. The penalty for making an excess contribution to an IRA is 6% per year. So could you put $1 million in your IRA? Now, Jill's not going to let you do that. That's against certain rules that she has to follow. If you were able to put $1 million extra in the IRA and report it as an excess contribution and pay 6% penalty per year, and then pull the $1 million out, this only works with a Roth IRA, and leave the income in, I think that's totally legal. Now, it takes some structuring, and you better be right, because you're paying the 6% either way, right? So 60 grand a year for any year it touches. So for example, don't put the money in January 31st, because you'd pay 6% for the whole year. They don't prorate it. That is not something I discuss much, because I do think it's legal if done right. And I think people who have lawyers who promote things too much attract attention they don't want. And so I'm very careful with that. That's a way to do it, but you better be right, because 60 grand a year on $1 million, if you double it in a year, you know, I have flippers who can do that and have done that, for
But
example.
can you take a loan on the IRA and then
No,
pay
absolutely
for
not.
my bonus?
No, sir. It's a prohibited transaction for any disqualified person to lend money to the IRA, and you are a disqualified person as to your IRA. Now, your uncle could do it, but the IRS would look very, very closely, because again, it might be legal financial incest, but it is financial incest. And the first thing they would look at is, did your uncle get money from you? Very first thing is they would ask him and mention to him, if you lie to us, you will go to prison. So think carefully, where did you get the money to lend to this IRA? And if the answer is he did it because it was a good deal for him, he's not a disqualified person, and the loan is structured reasonably, right? It's not a 0.5% loan over 372 years with no collateral. I mean, it's a reasonable commercial loan. That probably will work. On the other hand, if it comes out that, well, actually, you know, Lashmika kind of gave me the money, he gifted it to me, he made me a loan, it kind of circled around, and then it made its way back into his IRA, you're dead on arrival.
Got it.
So yeah, if you got a happy rich uncle that's willing to play ball, everybody needs a happy rich uncle who's willing to play ball. I lack one of those.
Cheryl, I see your hand raised. If you want to ask your question, I've unmuted you too. So Cheryl will be our last question. That's all I have for us. If we
Did it work, or am I
Yes,
still muted?
I can hear you now.
Awesome, thank you. John, by the way, I love your style. I'm enjoying this quite a bit and learning a lot, so thank you so very much. I have I have a Roth IRA, and I've purchased some properties subject to the mortgage.
Oh, I love
it. Yay, right? And now you're making me a little nervous from your talk today about if I did it okay and correctly, and my goal is to reduce or avoid UBIT, which is what I was looking for from here. And you said that I can't switch it now, right, to a 401 solo 401k. So and I have one of them I took subject to mortgage, sold on a wraparound mortgage. So are there best practices or good ways you can tell me to, I don't know, keep me compliant? Jill's got covered, but to reduce or avoid the UBIT on these transactions, like, does it count when you take them subject to the mortgage, are you counting as borrowing then?
Oh yeah.
Sweet.
Yeah, no, it counts as borrowing. So you got a UBIT issue. Depends though on, I mean, so let's talk this through, because there are different strategies. So this is a Roth IRA, right?
Yes.
Okay, so it cannot be rolled to a Roth 401k. So your very first goal is to start doing this on a Roth 401k. You really, 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 really want a Roth 401k. So if there's a way between contributing to one, between rolling traditional IRA money, I don't know what you've got out there in terms of tools. I really want this done in a Roth 401k. And that way the UBIT issue just goes away, at least on the borrowing. Now, when you turn around and sell, you have to be a little bit careful there. We see this issue with people who do sub 2 and large volume outside of IRAs. Their attitude is, we took sub 2, we're selling it on a note. A couple thoughts there. A, if you do it enough times, you're a dealer outside the IRA. If you do it enough times inside an IRA, you pay UBIT not because of the debt, but because you're selling inventory. John, I didn't mention to you, but I actually took 20 properties in my IRA subject to, and I sold all of them on a note. You're paying UBIT on that. That's a trader business. You're flipping. No, John, you didn't hear me. I did not get cash. I sold on payments. That makes no difference. The IRS looks at, in a dealer context, which is what this really is, if you have those numbers. So I'm warning you ahead of time. They would say, no, that's an ongoing trader business. And by the way, they would win that argument. I don't think there's much gray there. Now, so the exit strategy on these, just like in the regular sub-2 context, we tell regular sub-2 clients outside of an IRA the same thing, to avoid this dealer issue, because it's phantom income. Wait, John, here's how it works. I took subject to for 100 grand. I sold on a note for 150. I got 20 cents down. Let's just say I got a low down payment for fun. What's my gain? 50 grand. Well, how much is the IRS going to tax me? 50 grand. Oh, but they're going to spread it out over time as I get paid. No, not if you're a dealer. If you're selling enough properties on notes, the notes that you receive are treated as cash. And that is unfortunately black letter law. It makes no sense, but that is the law. Now, our counter argument is, well, maybe the note's not worth 150, it's worth 120, but you still got phantom income. I argue to make it less. So we really encourage clients to rent these properties for at least 18 months, preferably 2 years. 12 months and a day is too cute. We encourage them to rent for 18 months or more and then sell. And that way, if there's UBIT, it's only UBIT on the amounts received in principal annually. In other words, you qualify for the installment sales method. That allows you to spread the tax out over the life of the note. Second, and super importantly, it converts your gain to long-term capital gain. And inside of an IRA, that matters. Something a lot of CPAs miss. I've seen this a billion times. Let's say you take a property sub-2, you rent it for 18 months, so it's more than a year. That is a long-term capital asset. So if there is UBIT, which if you borrowed on it sub-2, there is debt on it, it's going to be, first of all, just the percentage of debt, not the whole thing. Because if it's a trader business and you're buying and selling, the UBIT would be on the whole sales amount. Here, it would be only on the percent that's considered to be debt financed, A. B, you held it for more than a year. It's not inventory because you rented it. And so your UBIT rate is only 20% instead of 37%. A lot of preparers miss this. I can't tell you, back when I still did tax returns, how many we amended, where the preparer reported UBIT on the sale of a long-term capital asset, such as a rental that has been rented out for more than the 12 months and a day. And like I said, I don't like cutting it that close. I like the 18 months. That is a capital asset. And UBIT has capital gains rates that are lower than the normal. Let me point out one other thing. I won't say names since this is Jill's show and I don't want her to be exposed to liability. There is a guru out there who promotes, and I'm not saying this is what you're doing. I don't know exactly what you're doing, but this made me think of something. There's a guru out there who promotes, I buy sub-2, the first warm body that gives me money, I sell to them on a note and I walk away. And if the person I sold to defaults, I tell the original seller, well, that's too bad. My contract says this is okay. I owe you nothing. I'm not bringing the loan to date. I'm not fixing the default. The contract says, and you agreed that I was going to sell this to someone else on a note. And if they defaulted, that is your problem. You are dead if that goes to court. The attorney general will destroy whoever does that. It's a matter of time. And it should be that way. And again, I'm not saying you're doing this. Let's be real clear. It's just that when you talk to me about a sub-2 that is later sold on owner finance, this particular guru is promoting walking away from the deal, taking basically an assignment fee for assigning the house to someone and disclaiming responsibility. There is no chance that will survive in front of a jury or in front of an attorney general. And I just want that as a general non-tax thing out there, because the people who do that ultimately will ruin it for everyone else doing sub-twos. They will get bad laws passed and attract very, very negative media attention.
No,
So
I
a
wouldn't
lot
do that
going on
for
there.
sure. But you brought up though now, so you said like rent first. Does it matter if it's like a lease option, because that's technically rent to own? Does that matter as far as your 18 months if they're not exercising the option, so it's not technically sold?
It depends on how it's structured. Most lease options are fine. In other words, don't structure it as a lease purchase. For me, that has a very specific meaning, that it is a sale from day one, and it's just structured as a lease, but it's a purchase from day one. Rather, you structure it as a true, honest to God, fair market value rate, very low credits received lease option. And once they've shown that they're good payers at 18 months, they have earned the privilege of buying from you on owner financing and reaping the benefits of appreciation and so forth and so on. You are still, and again, I've done a lot of sub-2 stuff, not just tax-wise, but in a legal context. That's why you're getting such a long-winded discussion.
I love it. Thanks.
But yeah, I mean, it's stuff a lot of people won't talk about. Jeff Watson knows a lot about it. I'm sure that you guys have had him on before. And he and I tend to be in accord on these things. The more rent credit you give them, or I should say, the more credit towards the purchase you give them on the option side. So let's say you have a lease option and every month they pay, you give them out of a $1,500 payment, a $300 reduction in the purchase price. That is functionally amortization. What you don't want is the IRS to look at the lease option arrangement and say that's a disguised note. You want the rent to be actual, honest to God, independent rent. And bear in mind, even if your option says you are responsible for maintaining the property in all respects, state law overrides that in all 50 states. You are the landlord if it's a lease option. You have a duty to maintain the place. And let's say if that person, there's actually a case where the repair duties were delegated to the tenant, and the tenant was negligent and screwed it up and sued the landlord for hiring a lousy repair person, namely themselves. And they won. So landlord duties to maintain are non-waivable. Now you let them do it, you put it in the option and you have to do this, but you keep an eye on it to make sure they're not screwing it up. Because if they do screw it up and hurt themselves, it's going to come back to you. So it gets complicated.
I had one last question for you, John, on the solo K. You said make sure that you sell or whatever on eBay or whatever for $2,000 a year. Does that have to be, well, because you don't have the 401k yet. So you get to do that on your own and you're not considered commingling because you do the $2,000 prior to getting the 401k?
They're totally separate things. You're not selling on eBay in your 401k.
Right.
You are personally selling on eBay to have what the IRS calls a trader business. And it is generating what is called compensation, because you can't just contribute any old money to a 401k. You have to have what's called compensation. How do we define compensation? It's subject to self-employment or Social Security tax, which selling on eBay would be subject to self-employment tax. And you spend time making it happen. In other words, it's not just that you put money into something and it dishes out income that is self-employment taxable. And so if you look at this example, and it could be other stuff, it could be consulting or whatever.
Sure.
I just like this example because it sticks in people's minds. Every year you have your hobby, you buy and sell, and you make $2,000 on eBay personally. And for such a small amount of money, I wouldn't even set up an LLC. It's just not worth it.
Right.
I would have a separate bank account that shows I make $2,000 a year. I would report it on Schedule C of my 1040. That is a trader business. That is all that is required for you to sponsor the 401k. Now, what's the problem with you only making $2,000 a year? Well, you can only contribute $2,000 a year to that 401k. Because when you have a non-corporate structure, how much are you allowed to contribute to the 401k? your net compensation for the year, which really means your net profit for the year, as long as it's Social Security taxable. Here, your net profit for the year is $2,000 a year. So you're not contributing a whole lot to the 401k, but that's not the purpose. The purpose is this is a landing pad for presumably a bunch of traditional money that you have somewhere else, whether in an IRA or a separate 401k from an old job or whatnot.
Got it. Thank you so much.
And by the way, I love sub-2s and Roth
They're my
401k.
favorite.
They're wonderful because, I mean, the terms are by nature arm's length. You don't have to have a whole lot of money. You do have the U-bit, but as long as you're renting it, you're not going to show much net income because of the depreciation. And once you sell it, you've got the installment sales method once you've rented it that spreads the tax out and keeps it at that nice low capital gains tax rate. So I think sub-2s are a great strategy, especially in the 401k Roth. I have a client who does those in his HSA and his Roth 401k in North Carolina, and he's going nuts with them. The number he's getting are unreal.
Thank you so very much. I'll need to speak with Jill soon.
John, how about one more quick one? I have 50,000 in my Roth. I have 50,000 in my traditional. I want to lend John $100,000. I combine them into one note. 50% undivided interest is my Roth. 50% undivided interest is my traditional. John pays me a payment of $1,000. I divide it into each account separately. I can do that. Now, what if I do a loan, same amount, 100,000. I'm going to do 50,000 first position and a note lending it to you at 5%. I'm going to do a second loan of my Roth to you in second position, loaning at 20%. Can I do that?
All right, the first one works, the second one doesn't. And as always, let's discuss why. That's the important part, especially when I'm telling you no and it makes you upset. You can have, this is a subtle distinction. The traditional and the Roth are joint owners of the loan, which is very different than them being in an LLC together. So let's walk through this first. They are essentially tenants in common, except it's not real estate. So joint owners, they are therefore not partners, which is very important. They are lending to me. The question becomes, did they need each other to lend to me? Because your IRAs are disqualified as to each other. And so just as we discussed before, where if I use my IRA to get me personally, John, into a deal that's a prohibited transaction, using your traditional to get your Roth into a deal, or using your Roth to get your traditional into a deal would also be a prohibited transaction. Now, here's the difference. Neither the IRS nor the Department of Labor have gone after the second scenario. But remember what my job is, to be paranoid. And so could they do that? Yeah. Now, the second one's blatant. They've actually just seen those, and I recollect at some point a ruling or a warning came out about, I'm going to use my traditional and it's going to make sure my Roth makes a ton of money. You got two issues there. First of all, you got a trigger, just an emotional trigger. Basically, I would call it artificial Roth stuffing. Artificially stuffing a Roth is a trigger to the IRS. Even if they can't get you for that, they'll find something else. That's just asking for trouble. Now, it'd be very, different if you could find someone else. Let's say just John Hyre, a non-disqualified person, lends, whether personally or out of his traditional, at 8%. And he's willing to do that because he's in first position. And your Roth is in second position and lends at least 20% of of the total deal, has skin in the game, and it's lending at 20%. It's in a riskier position. So again, this is what normally happens in the market. It's a good narrative if it's not a disqualified person. The problem we have with the scenario you presented is the traditional is being used to pump up the return in the Roth. What will catch the IRS's attention is the Roth stuffing. And what will give them an angle to make you pay for it is you're using the assets of the traditional to assist a disqualified person, the Roth. So the trick is just find somebody else to step in the shoes of whatever your traditional was going to do.
Got it. Thanks. We have two more questions if you're up for it. Alex and
Yeah.
Stephen, if one of you want to.
I love doing this. Look, because the more money you people keep and the less those people in DC get to misuse, the better.
So if Alex or Stephen want to ask their questions, here we go.
Okay, I'm Stephen. Hi. I just wanted to know on a Roth, to make the annual contributions to the Roth, do you have to have W-2 income in order to do that?
You have to have compensation.
Okay.
W-2 income is one form of compensation. The other form of compensation is net profit from a non-corporate business that is self-employment taxable and you helped spend time generating. Let me repeat that, that's a mouthful. Compensation is either W-2 or from a non-corporate business, it is net profit that is Social Security taxable and you helped generate the profit with your time. And by the way, what's the problem for some of you? Like, let's say you have a sole proprietorship, a Schedule C, and you want to contribute. A lot of you don't know how much the business made until way after the first of the year. You don't know if there was a net profit or how much there was. And that's where it can get a little ticklish. Or you're so good at tax deductions, you ended up showing a loss. And then you have no net profit that's Social Security taxable, and so you lack compensation. But the good news for an IRA is the compensation can come from anywhere since it's an individual retirement account. With 401ks and similar employer plans, it has to come from that employer. So for example, I work a W-2 job, I have a 401k there, I have a side gig, I have a solo K there. Does the W-2 money I get at my regular job count towards my solo K? It does not. Only income from the business counts for the solo K or for any 401k. But for the IRA, compensation from any source counts. So the typical issue is you got landlords that they just make rental income, no self-employment tax, therefore not considered compensation, therefore not able to contribute to an IRA or 401k unless they restructure their affairs.
Okay, and then related question, thank you, is for that compensation, can it be split if you're filing jointly with your spouse? In other words, can one spouse earn the whole amount of, and then both people put money towards the Roth?
For an IRA, yes, subject to some rules.
Okay.
So can the compensation of one spouse, if you're married filing jointly, count for the other spouse's contributions to an IRA? And the answer is usually yes. And I think the exception is when the second spouse qualifies for some other retirement plan, even if they don't use it.
Okay. Thank you.
You bet.
Thank you, Stephen. Alex, if you'd like to ask your question.
Yes. So you mentioned, John, about syndication. And so my question is, you know how when you are an investor for the single family, you get depreciation and cost seg and things like that. So when you participate as an investor in syndication, does that also apply that you get the depreciation and the cost seg of your portion?
If the operating agreement says so, and usually the operating agreement says so.
Okay. And so how would that break down if there were, say, 20 investors investing in this syndication of a 2 million or something like that? Does that like proportion into what the amount that I invested, or?
Usually. What normally happens is only the limited partners get depreciation. The general partners usually forego it. and it's split amongst the limited partners based on contributions is how it normally works. I've seen some exceptions. They're fairly rare.
Oh, I see. Okay. All right. So then when you're collecting the incomes, like after 2 years or whatever, you could basically take your depreciation and cost seg on the first year of the income you received. After like 2 years later, whatever they tell you, that's when you can just write off the whole thing and you wouldn't have to pay any taxes on that. Does that make sense?
Assuming that you don't have a passive loss problem. In other words, if it's coming to you as opposed to an IRA, it's a passive loss to you unless you're a real estate professional. And that's what a lot of the syndicators forget to tell you. They'll say, well, we're going to give you all this depreciation. And then they forget to mention that you're not allowed to use. So real estate rental is passive by definition. One of the few ways to make that income not passive, because what's the problem with passive income? It hibernates on your return until one of two things happen. Either you generate passive income and then it offsets, or you sell the activity that generated the passive loss and then you can take the loss. So if it's a passive loss, let's say they do a cost seg and you get this huge K1 loss, but then your accountant says, sorry, that's passive. And so it's going to hibernate on your return. It does you no good. So you have to be in a position, typically it means you're a real estate professional, which is harder to qualify for. Now, if your IRA is receiving all of this, it probably doesn't matter unless it's subject to UBIT. And then you have to recalculate the depreciation, by the way. When you're recalculating income for UBIT purposes, you calculate the income the same way you do for a human. For example, you can 1031. Let's say I have a leveraged property in an IRA and it's getting sold and I don't want to pay the UBIT. I can 1031 to defer the gain. The one difference on IRAs is depreciation is calculated differently. You can't just go off the K1. You actually have to recalculate the depreciation because IRA depreciation, or I should say UBIT depreciation, is lower than regular. There's always complexity.
How much lower? Is it a lot lower or is it like?
It's a lot lower. You don't get bonus depreciation.
Uh-huh.
And the tables that you calculate the depreciation on are much slower for UBIT. What you'd want to ask your accountant about to compare ACS, that's the tables, there's a specific set of tables. The ACS tables compared to the maker's tables. The maker's depreciation is much more rapid than ACS. When you're calculating UBIT, you have to use ACS and you don't get bonus depreciation.
I see. Okay. Interesting.
Except
you.
on Thursdays.
If it's raining in Chile. John, thank you so much for hanging with us, and thank you everyone who's attended. It was a long one tonight, but a lot of great information. Again, this was recorded, and we'll send out a recording to you after the fact as well. And if people couldn't attend or had to drop off, they'll get the whole recording. John, thank you so much for joining us tonight and giving us all this great information. Appreciate it.
It was a pleasure, and thanks for having me, and thanks for listening to the disembodied voice that I became.
Yeah, and if you guys have any additional questions too, you can email them over to john@help@realestatelaw.com or info@iPlanGroup.com, and we'll get you over to the right team to help you out.
Take care.
Thank you, everyone. Good night.